how Trump's Venezuela move could impact the global economy. There's an oil tanker sitting off the coast of Venezuela right now that can't move. Not because it's broken, not because of weather, because nobody knows who legally owns the oil inside it. The cargo is worth $47 million. The ship has been idle for 6 weeks. And the reason involves a decision made in Washington that most people didn't notice, a regime in Caracas that most people stopped paying attention to, and a commodity market that connects both to your mortgage rate. This isn't about foreign policy in the traditional sense. This is about what happens when you weaponize access to the global economy, and what happens when that weapon doesn't fire the way you expected. Let's rewind. January 2025. Trump announces renewed pressure on Venezuela, specifically on its oil sector. Sanctions that were eased under Biden get reimposed. Licenses that allowed certain companies to operate in Venezuelan oil fields get revoked. The stated goal is regime change, force Maduro out by choking off revenue. The announcement gets buried under other headlines. Most people scroll past it. Venezuela has been a basket case for years. Hyperinflation, millions of refugees. A government that's been on the edge of collapse since 2015. What's one more policy change? But here's what most people miss. Venezuela isn't just another struggling nation. It has the largest proven oil reserves on the planet. Bigger than Saudi Arabia, bigger than Russia, 304 billion barrels. And when you restrict access to that much oil, even oil that's difficult to extract and refine, the ripples don't stay local. Here's how oil sanctions are supposed to work. You identify a regime you want to pressure. You cut off their ability to sell their primary export. Revenue collapses. The government can't pay its military, can't fund its patronage networks, can't maintain legitimacy. Eventually, something breaks. The regime falls or negotiates. It's economic strangulation with a clear theory of victory. Except oil isn't like other commodities. It's not regional. It's not substitutable on a whim. It's the most globally integrated market in existence. Every barrel affects every other barrel. And when you remove supply from one part of the system, the pressure shows up everywhere else. Venezuela was producing around 800,000 barrels per day before the new sanctions. Not a lot compared to its potential. But in a tight market, 800,000 barrels is the difference between stable prices and a spike. Let's talk about what a tight market actually means. Right now, global oil demand is around 100 million barrels per day. Supply is roughly the same, which sounds balanced, but it's not. Because there's almost no spare capacity, no cushion. Saudi Arabia has maybe 2 million barrels per day it could produce if it wanted to. UAE has another 500,000. That's it. Everyone else is running near maximum output. So when you pull 800,000 barrels off the market, you're not just removing Venezuelan oil, you're removing the margin, the buffer, the thing that keeps prices stable when something goes wrong. And things always go wrong. A refinery catches fire in Texas. A hurricane shuts down Gulf production for a week. A pipeline in Kazakhstan springs a leak. Normally, spare capacity absorbs the shock. Prices tick up slightly, then settle. But without that cushion, every disruption becomes a price event. Here's where it gets complicated. The sanctions don't technically ban all Venezuelan oil. They ban US companies and anyone using the US financial system from buying it. Which sounds limited, until you realize that almost every major oil transaction on the planet moves through banks that touch the US system. So even if a Chinese refinery wants to buy Venezuelan crude, they have to find a bank willing to process the payment without triggering secondary sanctions. And most banks won't. The risk is too high. Get caught facilitating a sanctioned transaction and you lose access to US markets. For a global bank, that's a death sentence. This creates a bottleneck. Venezuelan oil doesn't disappear. It still gets extracted, but it flows through a much narrower, murkier network. Shadow tankers, shell companies, middlemen taking cuts at every step. And the volume that actually reaches the market drops. Not to zero, but enough to matter. Now let's follow the chain. Less Venezuelan oil means global supply tightens. Tight supply means higher prices. Higher oil prices mean higher costs for everything that moves. Shipping, manufacturing, logistics, plastics, fertilizer, which means inflation. And here's the irony. The US economy just spent 3 years trying to wrestle inflation down. The Fed raised interest rates 11 times. Borrowing costs spiked. Mortgages hit 7%. The whole point was to cool demand and stabilize prices. It worked. Inflation dropped from 9% to around 3%. The Fed started talking about rate cuts. The worst seemed over. Then oil prices start climbing again. Not because of demand, because of supply. And supply-driven inflation is harder to control. You can't raise interest rates enough to make people stop driving to work or heating their homes. So the Fed is stuck. Do they hold rates high and risk a recession? Or do they cut rates and let inflation tick back up? Let's zoom out. Why does any of this matter to someone who doesn't follow oil markets or foreign policy? Because oil prices are the closest thing the global economy has to a thermostat. When oil is cheap, everything else gets easier. Shipping costs drop, businesses expand, consumers have more disposable income, growth accelerates. When oil is expensive, the opposite happens. Costs rise, margins shrink, spending contracts, growth slows. And the weird thing about oil is that the price isn't just set by supply and demand in the present. It's set by expectations of future supply and demand. Traders bidding on futures contracts based on what they think will happen 6 months from now, which means uncertainty is just as dangerous as actual shortages. If traders think Venezuelan oil might disappear entirely, they bid prices up today, even if the barrels are still flowing. This is what happened in 2022 when Russia invaded Ukraine. Russian oil didn't vanish overnight, but the fear that it might send prices to $130 a barrel. The actual supply disruption was maybe 2 million barrels per day. The price spike reflected fear of 10 million. Markets don't wait for disasters. They price them in early. So what's the Trump administration betting on? That the pain from sanctions will fall on Maduro, not on the global economy. That Venezuelan oil is replaceable. That other producers will step in to fill the gap. And in theory, that's possible. Saudi Arabia could open the taps. Shale producers in Texas could ramp up. Canadian tar sands could increase output. But here's the problem. Saudi Arabia doesn't want to. They've spent 2 years deliberately holding production back to keep prices high. Their budget requires oil at $80 a barrel. If they flood the market, prices drop and their economy suffers. US shale producers could increase output, but it takes time. Rigs need to be reactivated, crews need to be hired, pipelines need capacity. You can't just flip a switch. And shale companies got burned in 2020 when prices collapsed. They're cautious now, more focused on returns than volume. Canada could help, but their infrastructure is maxed out. They don't have the pipeline capacity to move significantly more oil to market. So the cavalry isn't coming, at least not quickly. Here's where the strategy starts to look shakier. Sanctions work best when they're multilateral, when everyone agrees to enforce them. But Europe isn't on board with this round of Venezuelan sanctions. Neither is China or India. Which means Venezuelan oil doesn't stop flowing. It just gets rerouted. Instead of going to US refineries, it goes to Chinese refineries. Instead of being traded openly, it moves through grey market channels. Venezuela still makes money, just less of it. And the global supply crunch still happens, because the oil that goes to China is oil that isn't available to Europe or Japan. The net effect is that the US imposes costs on itself and its allies, while only partially achieving the goal of squeezing Maduro. Let's talk about refineries, because this is where the complexity really kicks in. Not all oil is the same. Venezuelan crude is heavy and sour, high sulfur content, difficult to refine. Most refineries can't process it without specialized equipment. The refineries that can are mostly on the US Gulf Coast. They were built specifically to handle heavy crude from Venezuela and Canada. When you cut off Venezuelan supply, those refineries have to scramble for alternatives. Canadian heavy crude, Mexican Maya, Middle Eastern grades, but those alternatives cost more, and they're not perfect substitutes, which means refining costs go up, which means gasoline and diesel prices go up. Even if total global oil supply stays the same, the mismatch between refinery capabilities and available crude creates inefficiencies, and inefficiencies cost money. Now let's add another layer. Venezuela owes money, a lot of money, around $150 billion in external debt, bonds that defaulted years ago, loans from China and Russia that were never repaid, claims from companies whose assets were nationalized. When sanctions tighten, Venezuela's ability to pay anything drops further, which means creditors take losses. And many of those creditors are international banks and investment funds. So the financial system takes a hit, not a catastrophic hit, but enough to add friction, enough to make lenders more cautious about emerging market debt in general. This is the contagion risk. Venezuela defaults harder, investors get spooked, they pull back from other high-risk countries. Borrowing costs rise for Brazil, Argentina, South Africa. Countries that have nothing to do with Venezuela suddenly find it harder to finance their deficits. And that slows global growth. Here's the part that gets uncomfortable. US gasoline prices are already politically sensitive. When gas hits $4 a gallon, approval ratings drop. When it hits $5, people get angry, and midterm elections are 18 months away. If Venezuelan sanctions contribute to a sustained spike in oil prices, the administration will face a choice: stick with the policy and absorb the political cost, or quietly ease sanctions and pretend it never happened. This has happened before. Trump imposed tough Venezuela sanctions in 2019. By 2020, the administration was quietly granting waivers to US companies. Biden eased them further in 2022 when oil prices spiked after Ukraine, then reimposed them, then eased them again. The pattern is clear. When geopolitical goals conflict with domestic gas prices win, which raises the question: if the sanctions are going to be eased the moment they start causing pain at home, what's the point? Let's talk about China, because this is where the second-order effects get interesting. China is the world's largest oil importer, about 11 million barrels per day, and they've been quietly buying discounted Venezuelan and Russian oil for years. US sanctions don't stop this, they just make it cheaper for China, because sanctioned oil trades at a discount, sometimes $10 a barrel below market price, sometimes more. So while US consumers pay more, Chinese refineries pay less, which gives Chinese manufacturers a cost advantage, which makes Chinese exports more competitive, which hurts US manufacturing. The intended target is Maduro, the unintended beneficiary is Beijing, and this is the broader problem with sanctions in a multipolar world. They only work if everyone enforces them. If there's a major economy willing to absorb the sanctioned goods, you're not cutting off revenue. You're just redirecting it. Here's the math nobody wants to do. Assume Venezuelan oil exports drop by half, 400,000 barrels per day. Assume that oil was trading at $75 a barrel. That's $30 million a day in lost revenue for Venezuela. About $11 billion a year. Sounds significant. Except Venezuela's government budget is estimated at around $10 billion, and most of that is funded by oil. So yes, $11 billion is a huge hit. But if global oil prices rise by $10 a barrel because of the supply disruption, Venezuela actually makes more money on the oil it does sell. 400,000 barrels at $85 is $34 million a day. They're exporting less volume, but earning more per barrel. Meanwhile, global consumers are paying an extra $10 on 100 million barrels a day. That's $1 billion a day, $365 billion a year, extracted from the global economy. Venezuela loses, but everyone else loses more. So what's the end game? Regime change? Maybe. But Maduro has survived worse. He's outlasted 3 US presidents. His military is loyal, his security apparatus is efficient, and he has support from Russia and China, both of whom would prefer the US not succeed in toppling a government through sanctions. The more likely outcome is stalemate. Sanctions stay in place. Venezuela limps along, oil markets stay tight, prices stay elevated, and the global economy absorbs the cost. Not a crisis, just a persistent drag, a few tenths of a % off global growth, a few more months before central banks can cut rates, a few more dollars at the pump, death by 1,000 cuts. Here's what makes this situation different from past sanctions regimes. The global economy is more fragile now, debt levels are higher, growth is slower, central banks have less ammunition, and the geopolitical landscape is more fractured. 20 years ago, the US could impose sanctions, and most countries would comply. Not because they agreed, but because the cost of defiance was too high. Now, China and India buy sanctioned oil openly. Turkey facilitates Iranian transactions. The US dollar is still dominant, but the system is developing workarounds. SWIFT alternatives, bilateral payment systems, digital currencies. Sanctions still work, but they're less decisive, more expensive to enforce, easier to evade, and every time they're used, the system adapts. Let's come back to that tanker. The one sitting off the coast with $47 million of disputed oil. It's still there. The oil is technically Venezuelan, but it was sold to a company in Dubai, who sold it to a trader in Singapore, who sold it to a refinery in India. Except the original sale might have violated sanctions, so the cargo is frozen, stuck in legal limbo. The ship is burning $10,000 a day in operating costs. The oil is degrading in quality. Everyone involved is losing money, and nobody knows when it will get resolved. This is what economic warfare looks like up close. Not tanks, not bombs, just paperwork and uncertainty in courts and frozen assets and losses that accumulate slowly. Clean, precise, invisible. So here's the uncomfortable truth. Trump's Venezuela move probably won't topple Maduro. It probably will raise oil prices. It definitely will complicate the Fed's job, and it might accelerate the shift away from dollar-dominated financial infrastructure. The intention is to punish a dictator. The outcome is a more expensive, more unstable global economy. And the worst part? This will happen quietly. No dramatic breaking news, no obvious crisis point. Just oil creeping from $75 to $85. Just inflation ticking from 3% to 3.5%. Just growth forecasts getting revised down by a quarter point. Nobody will connect it back to Venezuela because the causality is diffuse, spread across millions of transactions, invisible in the noise. So maybe the question isn't whether this policy will work. Maybe the question is, who decides whether the collateral damage is worth it? Because someone is going to pay. It's just not clear yet who, or how much, or for how long.